This is the economic highlights with markets closing on February 1st, 2019. Overall, the markets are up for the week with the TSX up 1% and the US indexes up 1.5%. The FTSE went up 3% while the Nikkei and Stock 600 were relatively flat. In January, that was a big month for North America. They actually had the strongest stock growth in decades, but most of this is due to the recovery of late 2018. As you can see, over the past 12 weeks, only the TSX is up, with all the other indexes being down over 1%. Looking at currencies, the CAD had a strong week, rising about 1% versus the USD and the JPY, and about 0.5% versus the Euro. The USD was relatively flat versus the JPY, but fell slightly versus the Euro. For Treasury bonds, all the yields in North America are down. As you can see, the 12-month Canada fell 2.5% and the 10-year US fell 2.5%. This is due to investors believing that rates aren't going to continue to go up in 2019 as previously expected, but I'll touch on that in a little later. In commodity news, oil had a strong week, with Brent up 2% and WTI up 3%. WTI is up more due to issues in Venezuela. Although they had a strong month, the prices of oil is still recovering from late 2018. Natural gas had a rough week, falling 12%, while lumber had a great week, up 10%. The interesting commodity to look at the moment is gold. It went up 1% this week and has continued to climb over the past 12 weeks. This is mainly due to the volatility of the market and the concerns over slowing economic growth. Looking at Canadian news, the retail sales numbers came out for November as well as the GDP numbers. Both had a rough month, with retail sales falling 0.9% and GDP falling 0.1%. Although that sounds pretty bad, this was expected and the market doesn't seem too worried about it. In the automotive industry, Canadians have been buying more automobiles from Japanese companies, while the automotive sector hasn't been doing too well in Canada. Automotive sales have actually been on the decline and fell 7.3% in January year over year. An interesting report I came across found that because of high consumer debt, many Canadians aren't saving for retirement. With the current low employment in Canada, I wonder if people will start reducing their debt levels and start saving for retirement. On the other hand, Vancouver and Toronto have some of the highest housing costs. A report by the CBRE found that Vancouver and Toronto have the lowest industrial vacancy rates in North America. This shows that residential housing isn't the only thing that is lacking supply in these cities. In other news, business leader Jim Basile calls out Canada's innovation claims as lies. If any of you have been watching the news for the past year, you may have heard about Canada's expansion in the tech sector and how Canada is becoming a leader. Jim basically said that most of this innovation comes from companies/employees of US tech giants. For example, Google will own a company in Canada, and that's where the innovation comes from. In oil news, Alberta is reducing the oil production cuts put in place late last year. These cuts were to address the low prices of WCS resulting from the lack of pipeline access. If you noticed on the earlier slides, WCS has actually gone up over 100% in the past 12 weeks. In company news, CGI Group reported a strong quarter with earnings per share of $1.11, up from 98 cents, and Shell posted annual profits up 36%. On the downside, Shell is continuing their outlook on minimal spending. While their profits are up, it doesn't look good for Shell due to the recent acquisition having an estimated WACC of 10%, while the return they received was only at 7.6%. SNC released this week that they cut their profit forecast for the year, and Rogers posted their earnings result with a beat of $1.13 versus $1.08. Bombardier Inc. also announced that they're planning on acquiring global 7500 wing manufacturing operations. Moving on to the US, the government shutdown temporarily ended, with Trump saying he will continue the shutdown if a border wall isn't funded by February 15th. S&P has estimated that the shutdown cost the US economy $6 billion, and the IRS believes that it will take up to 18 months to recover from this time period of non-work. The US and China started trade talks on Wednesday, with Chinese officials arriving at the beginning of the week. Now, tensions are still high with the US and China, and US prosecutors filed criminal charges against Huawei for allegedly stealing trade secrets and committing bank frauds. While the tensions are still high, the trade talks seem to be making progress, with China discussing about buying more US goods. With the craziness going on in Venezuela, the US is planning on putting sanctions on the Venezuelan state-owned oil company. As I talked about earlier, WTI was higher than Brent increase for the week, and I believe that that's probably one of the reasons why. And the Federal Reserve decided to leave rates unchanged and are talking about taking a more stable approach for the year. Now, the market doesn't expect that the Fed will actually raise the rates in 2019 after this decision, and this led to a strong day in US stocks. What's actually surprising about this is most of the market was forecasting at least 2 rate hikes for the year. While the shutdown did concern many about the economy, the ADP actually did a survey and found that 213,000 jobs were added to the private sector in January. Now, this did come before the earnings report on Friday that found that 304,000 jobs were added for the month, which is way higher than what it was expected, and wage growth grew 0.1%. While the shutdown did have some impact, it seems minimal for the total economy with total job growth. This was a big week in company news for the US. Up first, Caterpillar had an earning miss of earnings per share of 255 versus 299. The company expects slower sales growth this year due to slow growth in China. The slower growth in China can also be seen through Nvidia reducing its quarterly forecast for the same reason. Nvidia fell 14% afterwards. The news from both of these companies pushed the market down for the day on concerns on global growth. On the bright side, Boeing posted their highest ever revenue of $101 billion for the year. They were up 6% after hours. Moving back to the dark side, PG&E filed for bankruptcy due to the California wildfires. McDonald's had a strong quarter with an earnings beat of $1.97 versus $1.89. I'm sure most people have heard about the layoffs in digital media, but I'm sure most people don't know how many companies are actually laying off employees. I didn't realize how many were. These are all the companies I know of: BuzzFeed, Reganeri 19, Mick, The Huffington Post, AOL, Yahoo, and Vice Media. This puts into question the viability of online media as well as if clickbait is actually sustainable. These layoffs make me think that building a brand off of clickbait type stories only provides short-term competitive advantage and probably makes the company seem more valuable than they actually are. For example, Vice had a valuation of over $5 billion in the previous year. This week was big for tech company earnings release. Microsoft had an earnings miss and fell 4% after hours. Amazon had an amazing quarter with net income up 63% and shares rose 4.8%. Although the next day they fell 5% due to the company lowering their revenue forecast. Facebook also had a very strong quarter with average revenue per user up 19%, while Tesla had their second straight quarter of profits but missed the mark and fell about 5%. Apple's revenue fell 4.5%, but this is less than expected, and they rose 5.5% on the open. AT&T also released their earnings with a disappointing quarter and fell 4.3% after hours. In total, the tech sector did all right, but they only rose about the same as the whole index. In other news for Facebook, they are ramping up the restrictions on political ads ahead of EU elections. Foxconn also has announced that they are potentially backing out of a $10 billion plant in Wisconsin due to slower growth forecasts. GE was up 8% after posting strong earnings for the quarter. In Europe news, the UK had the strongest wage growth since 2018, and unemployment fell to 4%. This is good news relating to the UK as worries over Brexit still continue. On the downside, the International Monetary Fund cut its forecast for the global economic growth, as it expects the overall economy is going to slow down in the coming years. An executive at BlackRock disagreed with this and believes that the economy will have a strong year. In banking news, Metro Bank announced that they misclassified some of their loans relating to risk-weighted assets. The bank stocks fell after the news because this means that the risk-weighted assets will immediately go much higher. With IMF's decision to cut economic forecasts, there is more troubling news surrounding the European economy. The PMI results for Germany, France, and Italy all came in below 50. This means that purchasing managers expect a shrinkage in future purchases. At the same time, Germany cut its 2019 forecast from 1.9% to 1%. These disappointing results led to the European Central Bank to keep interest rates the same, and looking into the future, they expect to keep rates low. In a press release, they said risks have moved to the downside. Inflation for the region was at 1.4%, and Germany is looking at removing the use of coal by 2038. There isn't much news in Asia recently, with the main news being the release of China's GDP for 2018 at 6.6%. This is the slowest growth in the past 3 decades, but was expected, so it wasn't too much effect on the market. China has also blocked the use of Bing, meaning that neither Google or Bing can be used by the Chinese population. Overall, the takeaway from this week is that markets are doing well and are still recovering from late 2018.